In this video, I'm going to show you the top 5 stocks that the best investors in the world just bought in the last quarter, and I'm going to tell you if they look overvalued, undervalued, and if I plan to invest in them. Every single quarter, professional investors have to file what is called a 13F. It outlines everything that they bought and sold in the last quarter. This website, Whale Wisdom, actually has created a scoring system to score all of the world's hedge funds to figure out who are the best performing ones, and then they track the top holdings of the best firms in the world. Here are the top stocks, the top 150 funds that Whale Score is tracking from the last quarter. On the left side over here are the ones that were most bought. So you can see number 1 was Workday. Number 2 was Marvel Technologies. Number 3 was Danaher. Number 4 is Bristol Myers Squibb. And number 5 is CVS. Don't stop watching the video. I'm about to jump into the charts and look at the fundamentals of these companies and tell you if they look overvalued or undervalued, if I'm considering any for my own portfolio. What is my portfolio? I share it very transparently here on the channel. I have a $114,000 portfolio. I put in 121, so we're down about $7,000. It was a tough week. We're down $7,000 this week. Overall, I'm down $18,000. Started the portfolio on February 15th, 2022. If you want to watch me keep losing money, make sure you like this video, subscribe to the channel, and turn the notification bell on so you never miss a money losing update. Here is my portfolio. I don't show you this to copy me. I show you this to be very transparent about the stocks that I own and don't own. And for the purpose of this video, I don't own any of the stocks that we're talking about. My top positions are Meta, Taiwan Semi, Shopify, Snowflake, and Rocket Lab. And then I've got all these others here, which if you want to follow my portfolio, there is a free link down in the description that lets you get real-time updates of my portfolio. All right, let's jump over to valuation. And I'm gonna let you know if these stocks are outperformers over the long term and if they look like they're currently overvalued or undervalued. Bristol Myers Squibb. Since 2002, it has actually underperformed the S&P 500. And if we look at it right now, this is its average PE since 2002. Black line here, price to earnings ratio is 10. The average PE has been 17. And so you can see it's definitely below its historical average, right? But what we need to look at is that growth is expected to slow down, right? And so what you can see is since 2016, the earnings growth rate has been 16%, and moving forward, it's only expected to be 1%, 4%, and 3%. So growth has definitely slowed down, right? And I don't expect this thing to get back up to a PE of 16, but it doesn't necessarily have to. It's down at a PE of 10. It is significantly undervalued. You have a margin of safety. It pays a nice 2.8% dividend yield, and its payout ratio is only 28%. So I would guess that that dividend is safe. You can see over the last 6 years, they've grown at about 5% per year. And so overall, it looks like Bristol Myers Squibb is, I think it's still Bristol Myers Squibb. Bristol Myers BMY looks undervalued to me. I need to do some more work before I consider buying a stock like this. All right, CVS, everybody's heard of it. We know what it does. It's currently trading right about in line with its historical PE. If we look at this blue line over since 2016, its blended PE right now is 11. Historical PE is about 11.5. And if it stays at its normal PE, you're looking at about a 10% annualized return through 2024, which is pretty darn good for such a reliable, steady company, right? It does pay a 2.3% dividend yield. Its payout ratio is only 25% and expected to stay right about that way. So they've got plenty of room to keep paying that dividend and even increase it over time. If we look at the performance over the last 9 years, they've increased their dividend at an average growth rate of 6.5%. It has trailed the S&P 500. If we zoom out a little bit more than that, they've increased the dividend at 16% per year, and it is actually beating the S&P 500 since 2002. So CVS is definitely one that's going on my watch list. I don't really own a bunch of dividend stocks right now, but it's a solid company and it's not going anywhere even in this, a recessionary type of environment. Danaher, I honestly have no idea what Danaher does. It's an American globally diversified conglomerate with its headquarters. They manufacture and market professional, medical, industrial, and commercial products and services. Okay, all right. Even if we don't have a ton of background on the company, we can still get an idea of its current valuation, right? So we see its blended PE is 24. Its historical PE since 2002 is 23, so it's right around that. But let's go back just to 2012, right? Still looking at a historical PE of 24. Average earnings growth rate has been 13%. So if we're looking at it, and over the next few years, we're looking at 5%, -1%, and 8%. In my opinion, this does not deserve to be trading at such a high PE compared to its average when its earnings growth rate is slowing down so significantly. It pays a very, very small dividend. And over the last 10 years, it has significantly outperformed the S&P 500, which is great. Over the last 20 years, it has also significantly outperformed the S&P 500. But if we go back to looking at the last 10 years, it was starting down at a PE of 17 in 2002, and now it's up to a PE of 24, right? And so that's how it's gotten such a strong return. The question I would have is, can it maintain this high PE? And you're not going to get a growth in price to earnings, right? You're not going to get another growth of 17 to 24. You're not, in my opinion, you're not going to get 24 to 34 or something like that. So this thing is pretty much looking like it's priced for perfection, and I am not interested in Danaher at this time. All right, Marvell. It's an American semiconductor company. They develop and produce semiconductors and related technology. It was founded in 1995. Had 6,000 employees in 2021 with 10,000 patents, right? Let's take a look at it. Okay, Marvell, just like the chips and semis industry, has been hit hard. And so it's currently trading at a blended PE of 20, which is right around its long-term average, right? If we look out actually over about 20 years, its long-term average is 35. But earnings growth was 21% during that time. And so actually over the next 3 years, earnings growth is expected to be pretty strong, 47, 20, and then 19%. That's pretty amazing. I would not expect this thing to trade up to a PE of 35. If we go back to the last 10 years, its normalized PE is 22. I think that's a lot more realistic. And so if it does get up to 22, wow, you're looking at a 28% annualized return. So this thing has dropped all the way from $89 a share down to $43 a share, 52% drop. It was at a price to earnings ratio of 60, now down to 20. So that's interesting. I wonder if something's going on. This is definitely going to go to the top of my watch list. I'm going to do some more research. Pays a 0.55% dividend yield. Over the last 10 years, it's underperformed the S&P 500, but we've got a big drop recently. And over the last 20 years, it's actually underperformed the S&P 500. So that's interesting. This thing looks very cheap right now. I want to learn more about the company, so I'm going to do another video on Marvell just to learn more about it and see if maybe it's an amazing opportunity right now, or if there's something wrong that's causing it to trade so much lower. Let me know if you've studied Marvell, if you have any opinion on it. Marvell, whatever. All right, Workday. Workday is an on-demand financial management, human capital management, and student information system software vendor. So it's a SaaS-style company that allows their customers to manage human resources, training, and student information, training information type stuff online in the cloud, right? And this one we need to look at on a price to sales basis. And if you look, the price to sales ratio is actually down to 6. Its average has been 15. If we go back to 2017, the average has been 11.7, still down at 6, which looks significantly undervalued compared to historical expected 20% growth, 19 and 19% growth. So even if it just gets back up to 11, you're looking at a 52% annualized rate of return. Workday's another one because of the quality company that this is one that I want to look at. We're looking at its free cash flow right now, and you can see how strong their free cash flow per share has been growing. It's grown. It's up at $5.46, which is some awesome growth. Operating cash flow is growing strong. Wow, this is a company I really want to look at. Share buybacks, they are diluting a little bit, 4.49% CAGR. It's slowing down, and I would expect that to slow down more coming up. So that's something to watch. Operating cash flow is getting stronger. Net income still in the negative, but getting closer to zero. Sales growth, as we talked about, has been very strong. And this is why we look at it on a price sales basis, right? It's a software company. They're still in growth mode, and it's paying like it's a 70 to 72% gross margin. If we look at Workday, it's actually, wow, it's trailing the S&P 500 now since 2012. Let's look at this stock. It made it all the way up to 296, which is a price sales ratio of 14. And now it's down 49%. So I'm going to dive more into Workday, and I'm going to dive more into Marvell and CVS is going to go to the top of my watch list. Let me know in the comments if you want me to share those videos or not, and do a full video on each of those companies, because these are 3 interesting companies. I'm not saying to jump in and buy them or anything like that. Do your own research. But we're looking at the best investors in the world, learning from them, and there's a reason why they're buying these stocks, right? Thanks for watching. If this was valuable, it helps me grow, and it's free for you. If you like the video, subscribe to the channel and turn the notifications on so you never miss an update. Thanks, and we'll see you next time.